hear me?
Yep.
All right, good evening, REI Live. How's everyone doing tonight?
Great.
So I am so excited to be here tonight to talk to you about my passion, which is investing in apartments. So first of all, thank you so much, Brian Tripp, for inviting me to talk tonight. Look forward to sharing with everyone why I love apartments, and hopefully by the end of this, all of you as well will love it a little bit more if you don't already. Or if you don't know anything about it, maybe you'll spark some enthusiasm to want to learn more. So this is definitely more of a surface level, basic intro to apartments. So for me to get an idea of my audience, who in here primarily focuses on, or if you're new, maybe you think you want to focus on wholesaling houses? Okay, what about flipping houses? All right, single family rentals. And anyone in here already doing multifamily 5+ units? Okay, that's good to know. I like to kind of have an idea of what my audience is currently working on, just to kind of guide the conversation, I guess. All right. So I divided this up into 3 basic segments. The first one, my journey about me, who I am and where I've got to where I am today. So that won't take long, but then I'll jump into the basics of multifamily and why you shouldn't overlook this asset class in your real estate journey. And then finally, I'll get into how you can be involved in multifamily investing with money or without money. So that's probably what you all came to hear. That comes at the end. Save the best for last. So a little bit about me. I'm local, so I live right here in Birmingham, Hoover. So I live with my husband, Casey, and we have a 5-year-old son, Carson. We're also expecting our second son right now, so come February, we'll have 2. So I have a background in science. I graduated from Mississippi State University in Biochemistry and Microbiology, bachelor's degrees. And what actually brought me to Birmingham, after I worked in a research lab for several years in Starkville, Mississippi, I came here to Birmingham to work on a PhD in immunology. I thought scientific research was what I loved at that point. I still love it, but I thought that's the career path I wanted to take. But once I got into it, I realized it's not the career path I wanted to take. It was really just kind of miserable. It was a highly political environment in scientific research and grant funding, and ultimately left that program. I would love to say I had some wonderful vision and just started a business the very next day, but the truth is, I was really just doing kind of a side hustle in electronics wholesale to make some money to get by until I found my next calling, and that turned into a business. I figured out that business had so much potential at that time because we had no competition in the Alabama area. So about 6 months after I started that business, my husband Casey quit his job. He was working with AT&T at the time. He had a pretty decent job, but he wanted to help me grow that business. So the 2 of us, we built that business from the ground up. This was, to give you like a point of reference, this was in 2013. Started the business in 2012. He quit his job in 2013. So we traveled all over the Southeast, and we visited all these different cell phone stores and built those relationships and made those connections, built that business. So about 5 years into that business, we had done really well. We were just looking for a place to passively invest our capital. That's what really got me interested into real estate to begin with. We couldn't really reinvest that capital into that business anymore at that point. So I was looking for, maybe single family rentals, maybe some type of passive investing. I just didn't know what I wanted to do with the money, but I knew I didn't want to put it in the stock market. That's where it was at the time, and I wanted something more tangible, something that I could control. I'm a very type A personality, so I like to control my investments a little bit more than the stock market. So at that point, I started reading all the books I could on real estate, all the different asset classes, learning about which one might be the best fit for us. I thought single family rentals might be at first. Like everybody, a lot of people start with single family that end up in multifamily. So we did acquire 2 single family rentals along that, kind of accidentally, just within my journey to figure out which asset class I wanted to pursue. But then I landed on passive multifamily investments. And the way I did that was I attended a ton of different conferences, you know, multifamily conferences and free content online and just really networking with everyone in that space I possibly could. And throughout that process, I met a lot of great operators that own thousands of units. So I decided to passively invest first. We invested in four different sponsors, around 800 or so units passively, just to learn the business. And I never thought I would really do it actively at that point. I thought I would stay passive. But once I got into that passive investor mindset of barely peeking behind the curtain and seeing how these larger assets really operate, seeing these sponsors execute their business plans and seeing those transformations and seeing the dollar signs they were making, you know, at that point I realized I wanted to do this actively, and I wanted to be the syndicator. I wanted to be the operator that actually did this full time. So by 2017 into 2018, I decided to make it my sole focus, you know, to really immerse myself in the business and to learn everything I could, you know, eat, sleep, breathe, multifamily, and to set out to become, you know, an active operator myself. So that's what I did. So from that point on, after the passive investments, we took down 6 different active deals. So most of those were around, I'd say the average size is 40 units, you know, 30 to 40 units each. So that 194 units between those 6 assets. Now, that's everything from me buying them individually on some of them to, you know, I took a partner or 2 on some of them, up to 3 other partners on one. So I own varying percentages of those, but they're definitely larger percentages than than I would in a passive syndication, obviously. So that's where I'm at today. We have the 6 active multifamily deals that I've done. We actually just sold one a couple of weeks ago. So that was a 30-unit deal in Charlotte, North Carolina. We sold that, we tripled our money in 18 months. So that was a lot of the market to thank for that. Obviously, it does take a little bit of effective asset management as well, but the market in Charlotte is very, very hot. And then we're also selling a 20-unit right now. It's closing in 2 weeks. And we'll double our money on that one in 12 months. So those 2 will drop off, but then we're adding 3 more, so 114 units under contract to close, and then possibly another 70. We just submitted an offer on today, I think we might get. So we're definitely in growth mode right now, trying to grow the portfolio. So right now I am working exclusively with Astra Equity. So I was joint venturing with 3 other partners. The 4 of us decided that we worked so well together. After the 3rd deal we closed as a team, we decided to form Astra. So we formed Astra Equity. My role within that team is asset management. So what that means is it's very different than property management. Some people get those 2 things, you know, confused and think they're the same. But as asset manager, my primary role is I am the primary point of contact for property management. You know, I'm the one that looks at financials and makes sure that we're achieving our business plan. So, you know, I make sure that we're turning enough units a month, and I make sure that we're bumping rents enough to meet our business plan and to achieve, you know, our pro forma. So that is my primary role. Let me get a drink of water. And that's what I love to do. You know, that's, even when I was a passive investor, I knew that asset management fit my personality type because I'm very analytical. I love the numbers. I love to watch trends. So I knew it was a good fit for me. So I want to talk to you for a second about why my first deal really got me hooked. You know, why my first deal confirmed everything that I had read in books and really let me know that I was exactly where I was supposed to be. And really, it was kind of addicting. It made me want to do it again and again and again and again. So my first deal was a 40-unit in Hueytown. You can see here there were 4 pictures of one of the units. I remember when we did due diligence on this property, so when we walked the units when we were under contract, I remember walking in this unit and my foot stuck to this black spot on the carpet. And I couldn't get my foot to come up. Like, my shoe literally came off as I was trying to get my foot up and had to pick up my shoe and walk out. It was bad. So this property was highly distressed. would not recommend it for someone's first deal, but I'm glad I did it now. I don't think I knew what I was getting into at the time. It was 70% occupied when we took over. Shortly after we took over, it dropped down to 50% because we had to get a lot of people out. I mean, there were a lot of people just not paying. A lot of people that weren't even on leases that were living there. It was rough. This particular property, the owner before me owned a large group of properties in Hueytown, and this property pretty much was the catch-all for anyone who didn't qualify for the other properties they put at this property. So yeah, I had a fun one on my hands with this one. So this one was $33,000 per unit. That was our purchase price on the deal, and we had budgeted around $10,000 per unit in renovation costs. So our plan was to go in with the vinyl flooring and two-tone paint and new countertops and electrical fixtures, plumbing fixtures, your typical moderate rehab. And it ended up taking more than that because we found surprises, of course. But we were pretty close to budget. So you can see what the interiors look like there on the right-hand side. Once we were finished with that, that's the same unit. And then there's just a bathroom for comparison. But one reason this was so addicting for me and really got me hooked was, first of all, just seeing the transformation. We went from D-class residents to C-class residents to B-class residents. It was almost 2 repositions. And right now we're still about, I'd say we're about 75% B-class residents and 25% C-class residents. So we're still not quite there, and it's been 2.5 years since we bought this, but just seeing that transformation was amazing. We kept 4 residents when we took over. We had to get most people out. Of those 4 residents, a couple of them were elderly and had lived there for 20 years. And it was so cool because, my husband, he's over there all the time, and, they say don't ever let the tenants know that you're the owner. Well, he breaks the rules because he likes to talk. So they all know he's the owner. But there's this one elderly lady there that she has thanked him so many times, and almost with tears in her eyes, just like so grateful because the conditions that she was living in before were not good, and we've come in and improved her unit with her living there and improved the property as a whole, and just seeing the gratitude from some of these tenants that just want a good home, that's been pretty awesome. But then, also even more addicting is the dollar signs that come along with it, obviously is pretty awesome as well. This is a chart. You don't have to read every number. I pulled this from another presentation I did a while back, but I wanted to just kind of show you, definitely not to brag, but I want to show you the potential of multifamily and how powerful it really can be with some of these value add deals. So the first column here, you can see where we were at upon acquisition. So when we took over, supposedly the net operating income was $92,000 a year based on their financials, the seller financials. It was actually less than that for a lot of reasons. I won't go into detail, but let's just say $92,000 a year was their net operating income. I paid $1.32 million, $33,000 a unit. It basically wasn't cash flowing. It says $1,600 a month, but like I said, we had to kick a lot of people out, and that dropped quickly. So it was actually negative cash flow for a bit. The second column is our pro forma. I won't really go into that. That's kind of what we expected the deal to do upon stabilization at year 2. Then the third column is what's important here. That's where we're at today. So you can see the net operating income of the property, so income minus expenses. We're now at $191,000, so we've over doubled the net operating income since we took over, which is a 37% cash on cash return, which sounds extremely high because that doesn't even count sale proceeds if we were to sell. But one reason that looks so high is because we were negative cash flow for a while, so you have to kind of average all that out. But it is still high 20s if you were to average it. So this is almost like, if those of you that are in single family are probably familiar with the BRRRR strategy, BRRR. When you buy it, you renovate it, you refinance it, you repeat. This is like a multifamily BRRRR. So we're actually in the process right now of refinancing this deal. We're going to pull out all of our capital and then some, almost double. our capital, and even with doing that, we're still only 55% loan to value on the refinance. So still very conservative. We could pull out more, but you know, we want to sleep well at night. This kind of pays our personal bills. I like looking at this property as kind of like my W-2 job because it pays our personal bills, and then all the other assets we have, we can reinvest that money into other, you know, to grow our wealth. So
how many units is this one?
this is 40. 40. This is only 40 units, so imagine 240. You know, so yeah, so even after the refinance is complete, we'll be over $10,000 a month in cash flow from this 140 unit asset with nothing invested, other than a lot of time. It did take a lot of time, but it was worth it. So that just shows you, I mean, I hope you can understand like the potential of multifamily from this 140 unit deal, and how, you know, you 10 of these, surely you can see how you can really grow some wealth in this asset class. All right, so I want to touch on some basics of multifamily before I get into the roles and how you can all get involved, because there's some things I want to make sure that everyone understands. So everyone always asks, why multifamily over single family? What's the benefits? Why should I pursue multifamily? Economies of scale is the reason that you will hear from most people. Everyone always loves to say economies of scale. And it's true. And it's true to a degree. It's not my favorite reason. But what that basically means is if you're replacing a roof on one single family home, compare that to replacing a roof on one 20-unit apartment complex. You know, if you had to replace a roof on 20 single family homes all spread out everywhere, there's no way you're getting as good of a price per unit as you are replacing one roof on an apartment complex. And the same goes for any major system. The same goes for, you know, if you have an apartment complex, you usually only have maybe 2 floor plans, 3 floor plans, maybe 1, depending on the size. But if all the floor plans are the same, it's much easier to buy bulk material, to do all the units the same, renovate all the units the same. You're not worried about every house being different and trying to remember which house has what and, you know, what colors, paint, and everything. It's just easier to do, you know, to basically renovate all the units the same if the floor plans are the same. And then another point that I want to make with economies of scale is property management. So in the single family space, I think you'd all agree the average is what? 10%? 10% property management fees typically. You might can negotiate 9 if you have, you know, volume. But that's pretty much the average. Now in multifamily, you'll land somewhere between 3% for your 100+ unit assets and maybe 7%, so your average 30 unit or 40 unit assets usually around 7%. I should probably point out that pretty much everything I talk about here is going to be for 20+ units. I've never bought anything less than 20 units, and I'm just not as familiar with that, you know, 5 to 15 unit range, I guess. So, but for the 20+ units, you're going to be somewhere around 3 to 7%. So you have a lot of savings there, not only in fees, property management fees, but also in just the overall sophistication of the property management company. In multifamily, you'll encounter more like institutional quality property managers that really have their systems in place and that really just provide a lot more value to you than your typical single family property manager. Obviously, it's not always true, but you just have more options. So that's one benefit. The second thing is scalability. Sounds the same as number 1, but it's not in my mind. So for scalability, I'll get one more drink of water. I swear this baby like crowds my lungs. I can't breathe, so like I get short of breath. I've been noticing that symptom this week, so of course the week I have to speak. But anyway.
Does he pay rent?
He actually cost a lot. Yeah, he needs eviction. So number 2, scalability. If you really want to grow in real estate, it is so much easier to scale in multifamily versus single family. You know, the amount of time it takes to close one single family house is really not that different than the amount of time it takes to close one 50-unit apartment complex. It's a little bit more time, a little bit more into it. So slight exaggeration there, but not much. I mean, you still got one set of loan docs, one appraisal, one closing you have to worry about. So if you're buying single family one by one, it's gonna take you a lot longer to get to where you're wanting to go versus just buying one apartment complex, right? And you could argue, if you buy a portfolio of single family homes, it's the same thing. I could go with that, but I think the disadvantage is, if you know you have an apartment complex that's in a great market and it fits your criteria, all 50 units are gonna fit your criteria, right? But if you buy a 50-unit single-family home portfolio, there might be 10 of them that are not really in areas you like, or 10 of them that are older than you prefer, or that are in worse condition. So it's just, to me, it's harder with single-family portfolios to really fit your criteria as well as you can with multis. So number 3, recession resistance. Some of this is true for single family as well, but it's just more so true for multi. So if you buy an asset that is cash flowing day one, you put long-term debt on that asset, which I consider long-term debt 10 plus years before your balloon payments due, so 10-year term. And you have adequate reserves day one. So for me at least, with multifamily, I always reserve at least $1,000 per unit on the front end, part of acquisition cost. So 50-unit apartment complex, $50,000 is going to be sitting in an account when I close. That's, just money there for a rainy day, in case something happens. So operating reserves. And then in addition to that, we also reserve monthly deposit to replacement reserve to cover CapEx items down the road. So if you have a cash flowing asset, you have long-term debt on that asset, and you have adequate reserves day one, it is almost negligible risk. As long as you operate it, obviously you can't just go to sleep after you buy it, but it's negligible risk, because if you have a downturn, if you have a recession, then at that point you're cash flowing. So why do you care? Just keep cash flowing. Rents don't typically decline in a recession. Your rents might flatten out. Maybe they're not increasing year over year, but your rents aren't really going to decrease much at all, if at all. So you just keep cash flowing the asset and wait till the recession's over, then sell it, right? You got long-term debt. It's not like you're forced to sell or refinance. So that's one thing I love about multifamily. So number 4, favorable debt terms. There's a lot of advantages, and I'm not going to go too deep into this, but a lot of advantages with multifamily that you can't find with single family. If your asset is $1 million or more, you qualify for non-recourse financing in multifamily, which, agency lenders typically will give you, mid-3s on the rate, 30-year AM. Second thing is it's non-recourse, and they only look at the ability of the asset to service the debt. So for those of us who are self-employed or who only do real estate full-time, we can't really go out and get a single-family mortgage where they're going to look for a W-2 income, right? So, but with multifamily, they look at the asset more than they look at the individual. There are definitely some other details there we need to go into. You have to have net worth and liquidity, but as far as actual W-2 income, it's not as important. So number 5 is my favorite by far. That's the reason that I love multifamily, and that's one thing that got me super excited about this to begin with, and that's the ability to force appreciation. So like I said, I'm type A, I like control to some degree, so I like being able to control what the value of my asset is, right? So, let me go to the next slide here. Before I can go into detail on how we force appreciation, I want to make sure everyone knows how multifamily assets are of value, because that's important to understand. So the formula here is the market value of the asset equals the net operating income divided by the market cap rate. So the NOI, the net operating income, all that is income minus expenses, doesn't count your debt service. It's simply income minus expenses is your NOI. The bottom part of this equation, market cap rate, the technical definition is that's the rate of return that you would get if you paid all cash for an asset. So if you went in, you bought $1 million property, you didn't finance it, you just paid $1 million for it, and if it's a 5 cap rate, you're making 5% a year on that asset. But what's more important to understand about this is there is a market cap rate assigned to each property or each sub-market, and that's how appraisers will value your deal. So they look at comparable sales of other multifamily assets that are similar age, stabilized or not, and they'll look at the net operating incomes of those properties at the time of sale, and they'll look at what cap rate that equates to, and basically assign a cap rate for the submarket. So for example, Hoover's where I live, so I'm using that as an example, but typically for an A or B class asset, the market cap rate is 5%. So if I own a property in Hoover, I go to sell, I know it's gonna be around a 5% that the appraiser is gonna use when they go to value my asset. So my net operating income of that asset divided by a 5 cap is gonna be my value that I can expect to get. So you look at this equation for value. You can't control market cap rate. I mean, the market dictates that. Cap rates may go up if we see a recession next year or a pullback, softening, whatever you want to call it. You may see cap rates go up a little bit. You can't control that, but you can control your net operating income. And if you control your net operating income and you increase your net operating income, you've increased the value of your property. So I like that control. So here's some ways that you can force appreciation with multifamily assets. So over here on the right-hand side, you have your income buckets. And then over here on the left, you have your expenses. So obviously, increasing income, decreasing expenses, same effect on NOI. NOI goes up, right? So you can take either strategy here. The number one strategy that most multifamily owners take is increasing the rents. That's by far the easiest and most effective, especially in today's market where rents are skyrocketing, especially over the last year. So there's 2 ways that you can increase rents. You can either renovate the units. If the market allows you to do that. Some markets you just don't have any demand for renovated units, so you have to know your market, obviously. But if you have a demand for a renovated unit, you buy a property, it's all classic units. You can go in with vinyl flooring, refresh the paint, maybe new countertops, maybe granite countertops, depending on your market. Plumbing fixtures, electrical fixtures, new tubs around. There's so much you can do to really refresh and make your unit more desirable, and then charge more rent as a result. Some units are, I've seen units $400 under market rent. So it's just amazing what you'll see. And then on the flip side though, in a lot of instances, you can actually raise rents without doing anything, especially in today's market. So in most sub-markets around here, we've seen around 7% rent growth in the last year. A lot of owners haven't kept up with that. They haven't raised their rents because they didn't want to lose tenants. So what we're actually seeing now is a lot of opportunities where even classic units, as is, you don't have to do anything to them. You can go in and raise the rents 7-10%. Once the tenant leaves, lease the unit for 10% higher, and you've instantly increased the value of your property. So we actually do kind of a combination of the 2. So what we'll typically do is we keep some units classic, lease those for whatever the premium is, just say $75 higher. We renovate some units, maybe lease those for $150 higher. So we kind of leave meat on the bone for the next buyer. That's what we like to do. Here at the bottom, other income, that's anything that's not base rent. So that's like your application fees, your pet fees, late fees, amenity fees, any kind of fees. You can really get creative with other income depending on the market you're in. You have to know your comps and know what your comps are charging. You don't want to just feed people to death, obviously. But, you have to do what the market's doing, and if your property, the subject property is not charging anything and your competitors are charging admin fees and application fees, and that's an easy one to implement and raise your NOI that way. So then on the flip side, you've got your expenses. Common ways you can decrease expenses would include things like renegotiating service contracts. So when you take over a property, they're paying X amount for landscaping, X amount for pest control, X amount for trash pickup. You can go in and renegotiate those rates with those vendors or find your own new vendors that are cheaper, and you've reduced your expenses. But I will say, always focus on income more so than expenses. I see a lot of people say they're buying a value-add deal because the expenses are high and there's no room to move rents, and sometimes that's the case, but if your expenses are already 50% of your income, which is industry standard, 50% expense ratio, probably aren't going to be able to cut that a whole lot, and if you are, it might hurt the operations of your deal. It might end up hurting the other side, which is income, so you don't want to do that. So I always focus on the income side. If I'm around 45 to 50% expense ratio on the expenses, then obviously I'll try to renegotiate service contracts, but beyond that, I just really focus on opportunities to increase the income. So I wanted to give you an example. This is another income example, just because it shows how a little bit goes a long way with value creation. So imagine you have a 100-unit asset in Hoover. You as the landlord negotiate a bulk cable contract. It's funny Brian Tripp mentioned cable earlier. We actually don't do bulk cable contracts anymore because people are not, we've done it one time, but people really aren't into cable anymore, I agree. But it's just a good example to illustrate it at least. But say as a landlord, you negotiate a bulk cable contract for $30 per unit with a cable service provider. For $20 a unit, for $20 a unit. And then when you sign leases, you charge the residents $30 a unit for cable. Still a good rate. But you've just profited $10 a unit. And your residents are still happy because that's cheaper than they could go get it for, right? So $10 a unit does not sound like much at all. It sounds like pennies. But at $10 a unit a month on 100 units, that's $12,000 a year in income. Still doesn't sound like a lot. But then you apply a 5 cap rate to that, which Hoover is a 5 cap market, and you've created $240,000 of value by something as small as $10 a unit. So, no, you wouldn't buy a property just to do that. I mean, $240,000 on a 100-unit asset is not really that much. But I wanted to show this example because I hope it helps you see. Imagine a $100 rent bump or a $200 rent bump. What about a $200 rent bump on a 200-unit asset? Now that's where your multi-million dollar value creation comes in. And that's what these larger syndicators are doing. So it's powerful stuff. Speaking of making money, I wanted to go over the 4 different ways you can make money in multifamily. The first 3 you probably already are pretty familiar with, so I'll go through that quickly. Similar to single family. Cash flow. Cash flow is simply your net operating income minus your debt service, minus your deposit to replacement reserves or your CapEx reserve that you're escrowing monthly. Whatever's left over after all that's your cash flows. That's money in your pocket. Then number 2 is your appreciation. So we just talked about forcing appreciation, value creation, but number 2 here is more referring to organic appreciation. So what that means is you're keeping up with inflation. If inflation is 3% a year, you can expect your rents to organically grow about 3% a year. You can sign renewals at 3% higher. Your expenses will typically also go up 2 to 3% a year. But because expenses are 50% of income, you're still always going to come out ahead over a 5-year hold, per se. So you make money over time with appreciation. Number 3, principal reduction. You're paying down your mortgage over time. That's self-explanatory. When you go to sell it, you get that back, principal that you paid. Number four was one of the reasons I landed on multifamily investing too, whenever I was originally deciding which way to go. So when we were in the electronics business, we were in a very high tax bracket. We paid a lot, like way too much in taxes. It was sad every time I had to pay taxes. So we wanted something to offset some of that tax burden. With multifamily, if you have a $1 million or greater property, it makes sense at that point to do what's called a cost segregation study. You will hire a third-party vendor, the cost segregation company, and what they do is they come out. Instead of you taking straight line depreciation at 27 and a half years, with a cost segregation study, it segregates all the different components of your property into 5-year, 7-year, 10-year. It basically amplifies your total depreciation number that you can write off. And then in addition to that, you can claim what's called bonus depreciation. It's current tax law. It's phasing out over the next few years, but currently it's still 100%. You can elect 100% bonus depreciation, which means you can take that whole write-off year one. So what that typically equates to, if you invest, just say $400,000 into a property. I'm using that number because that was our first 40-unit deal. You invest $400,000, do a cost seg study, claim bonus depreciation, your write-off for year one will be very close to $400,000. It's usually around 80 to 90% of your investment. That's huge. So yeah, our first year with that asset, we had like a $370,000 write-off that not only canceled out any income we had from that property, but because I claim real estate professional, which is a box you check on the taxes, and you have to qualify, you have to spend more time in real estate than any other business. You can't have a W-2 job and do that. But because I claim real estate professional, I was able to use that write-off and cancel out my income from the other business. So especially for those of you who are making a lot of money in flipping houses or wholesaling houses, you're already in real estate, you could qualify for real estate professional. If you could use some of these tax benefits from multifamily to turn around and cancel out your income from your other real estate ventures, that's powerful because it's the power of compounding, right? I mean, you don't want to pay taxes now. You'd rather defer them as long as possible, use the money for something else. So that was huge for me, at least, was being able to cancel that out. And what's great is the more and more assets we buy, the more and more cost seg studies we do, our tax returns are always showing huge losses, when that's not the case at all. So, I don't pay taxes. Not anymore. I paid them for a long time. I'm glad I don't anymore. Now, you will have to recapture a lot of that depreciation when you sell, but the idea would be to hold these assets longer term. And obviously, by the time you finally sell, you have so much equity in the property, a little bit of depreciation recapture is not going to hurt you. All right, so I'm almost to the point where I'm going to talk about how you get involved, but real quickly, I just want to make sure you understand there's 3 different ways to structure these deals individually. I don't even need to go into that. Use your own money. JV is where all partners are actively involved. Usually you have 3 to 4 max. Anything over 4 partners. Typically, an attorney would tell you syndicate it because you can't have 4 plus active partners. And then finally, syndication. Syndication is where you have multiple investors pull their money together to buy an asset. You have active investors, which are your general partners or your operators, the ones that do all the work. Then you have your passive partners, which are your limited partners. All they do is give a check and collect returns. Totally passive in that situation. You'll find syndications typically in 100 plus unit, sometimes 50 plus unit assets. You don't really find that too often in smaller deals. All right. So now to the part you are probably wanting to hear the most. How you can earn equity in apartment deals. I like to break this into 3 buckets. This is kind of how my brain thinks about it. 3 different ways you can be involved. The first one being capital. If you have money, or if you know a lot of people with money and can basically bring money to the table, then you would fall into the capital bucket. 2 would be deal sourcing or finding deals, and then 3 would be operations. That's everything that happens after you close on a property. You're basically making it a success, doing all the work. So on the capital side, number 1 would be you have capital to invest. If you have capital to invest and you want to invest passively and do no work at all, you can expect somewhere around, which has definitely dropped a bit over the past year because the market's gotten so hot, but I would say right now the average is around 6 to 8% cash on cash return, which means that's what you get monthly or quarterly, depending on how distributions are done. Doesn't count profits from the sale. If you count profits from the sale, you can expect somewhere around 14 to 18% average annual return over like a 5-year hold. That's a passive investor. So if anyone does want to get involved passively, I'd love to talk to you. If you email me, my email will be at the end of the presentation here. If you ever want to talk more about passively investing, I'd love to have a conversation. So number 2 would be if you can raise capital from others. Maybe you know a lot of high net worth individuals or family, friends. If you can bring some of those investors to the table, at that point you're helping them because you're providing them with an investment opportunity that returns much better than the stock market. And you're also helping the experienced multifamily operator because you're bringing capital to their deal. So in a lot of cases, if you do that, the operator will let you be involved, will give you an active role and kind of teach you the ropes, let you see behind the scenes. You would have to be active. You couldn't just raise capital and do nothing else. SEC laws. And then number 3 and 4, I added this just for completion. I'm not going to talk about it. I don't recommend it for first time. If you don't know the business well, don't sign loans and don't front earnest money. You really have to know what you're doing to do those 2 things. But that is other ways you can earn equity on the capital side.
On the distribution, do you guys do a preferred return for your investors?
Depends on the deal. So in our JV deals, we don't. So our syndication attorney advises us not to offer preferred returns or any type of fees for JVs because everyone's got to be active, everyone has voting rights. For syndications, we would structure it with typically a 7 or 8% preferred return. That's what investors like to see these days. And then another common structure would actually be to have a Class A investor and a Class B investor. I don't know if you've seen that, where Class A is a higher pref, Class B is a lower pref. You'll start seeing a lot more of that. There's a lot of groups doing that now, and it's catching on. But I could talk about that for a long time, and I'm already going over. So I better get back to it. So that's the capital side, and let me go to the next slide to talk more about finding a deal and operations. So finding a deal is by far the easiest way that anyone with no money at all and no experience at all can earn equity in apartment deals and learn the business if you want to do that, if you think you're interested in that. So if you find a deal and bring it to an operator, so say my team, if you were to bring it to my team and we close on that deal, you would have an option. You could either take a finder's fee, similar to wholesaling single-family homes. You could take a one-time check, and if you like transactional income and that's for you, then you can do that. Or you can choose to take equity, so ownership in the deal. Maybe you get 3-5% of the 100-unit deal. But that means you get to share in the cash flow from that deal. You get to share in the sale proceeds from that deal. And most importantly, if you're interested, that means you actually get to learn alongside the operators. And they'll let you be on all the calls. In my team's case, we have property management calls weekly. You could be on those calls. You could see what we're doing on the renovation side and how we make a business plan for these assets and how we achieve it. So acquisitions isn't my thing. Like I said, my role is asset management on my team. We have an acquisitions guy. He could talk to you about this a little bit better, but it's basically the same as wholesaling single-family homes. You can go direct to seller with cold calling, or with mailers, or with driving for dollars. Find distressed assets, look up who the owner is, call them. Broker relationships refers to multifamily brokers. So multifamily brokers do the majority of the volume. There's not as much direct to seller as there used to be. So you would just have to form those relationships and get in good with those brokers to where they give you the deals first before they push them out to market. Number 3 and 4, this is where your relationships come in with your property management companies or your contractors. You know, if you own a lot of single-family rentals, it could be that your property manager also manages multifamily rentals, and they may know when one of their owners is wanting to sell. So, but they're never going to tell you if they don't know you're looking for it, so you have to let them know. You have to tell everybody what you do. Same thing with contractors. Maybe your painter or your flooring guy, they may work in apartments, and they may know when there's a distressed asset that might be worth calling. Or they may hear that an owner wants to sell. So it's just, you know, it's definitely a relationship business, and you have to let everyone know what you do and follow up. Same thing with single family. You know, eventually you'll land a deal. Bring that deal to an experienced team, and we'll give you equity. So on the operations side, if you think you're actually interested in being an operator one day and taking on one of these roles, this is how I get free equity in deals, is on the operations side. You know, I don't find the deals myself, our acquisitions guy does, but I asset manage the deals, and I'm the boots on the ground for our team. So that's how I earn free equity without putting in my capital. Now I do put in my capital as well, but I get extra equity for that. So that's how we structure it. Now the underwriting and due diligence piece, that's basically the deal analysis when you get a deal. You can't really back with a napkin check multifamily. You know, larger multifamily doesn't work. You'll end up missing out on a good deal or pursuing a deal that's no good. So you really have to do a full underwriting if it looks promising, and that kind of just comes with practice. It's an art. And then the asset management piece I talked about already. Construction management, a lot of times if you have someone that's experienced in multifamily renovations, someone that can project manage and has that background, a lot of times that person can gain free equity in apartment deals because you want somebody on your team that, you know, has a vested interest in your asset that can help you with this. Now, hiring a third-party project manager is also an option, yes, but we have someone on our team that's a construction manager.
What are you paying on that,
What are we paying?
as far as them being part of the team?
So our structure for Astra is we're 25% owners each. There's 4 of us. We're all equal.
So the
25%.
project manager would get 25%?
He's not just a project manager, so he does a lot. He's a high net worth individual that signs loans for us and also project manages and also puts in his own capital in every deal we do. And there's more to it than just project management, but he has a multifamily renovations company, so he can source cheap materials and, you know, there's a lot of other benefits than just the project management piece, because yes, you can hire that out, but sometimes it makes more sense to actually have someone as part of the ownership group that has that experience. So these operational pieces, if you think that you would be good at one of these things based on your background, the problem is it's hard to break into multifamily by offering one of these roles. The easiest, I would say, is construction management. If you've got a lot of experience there, you might be able to gain some free equity with a team that way. But for the most part, it's going to be hard for a team to give away free equity in a deal if you have no multifamily experience and you say, hey, I think I'm good at asset management. Can I do that? You know, they're probably going to be like, hey, come back when you've done a few deals. So that's why I say finding a deal is the easiest way. Because you find a deal, bring it to a team, gain that experience that way, and then if you think you're good at one of these things, that's your time to shine once you're in the deal. And then you build your credibility. Once you're in the deal, then you can say, well, I've done X number of units, or I've asset managed, you know, 2 deals before, and these are the success stories we have. So then you can actually add value to a future team or do it yourself at that point. So if you find a deal or you have money to invest, those are the 2 easiest ways to kind of get a leg up and get into the actual experience pieces, because these things here come with skills and experience. All right, just a few top lessons that I've learned Number one, trust but verify. I don't even count this as one of my deals. I didn't count this in my unit counts or anything like that, but there actually was a 96 unit deal that I was a part of before I started buying my own deals. And what I learned from that is the actual numbers of the deal are not nearly as important as the partners of the deal. You can have a killer deal on paper, but if you've got the wrong partners, they'll run into the ground. Or you can have a so-so deal on paper and you have the right partners and they'll hit it out of the park. So don't be overly eager to get into the business and ignore red flags and jump right into a bad partnership, because it can really make or break, your journey here. So always vet your partners well, get to know them well, trust your gut. I learned a lot from that, and that's one reason I did some deals on my own before finding my 3 partners now. We worked super well together. We formed Astra Equity and couldn't ask for a better partnership, a better situation, but I didn't force that. It just kind of happened naturally. And I had to go through some rougher experiences, I guess, to get there. So the second thing, and this goes for any part of real estate really, is always expect surprises, but especially in multifamily. So if you're budgeting for a single family flip, rehab, and you miss, a certain scope item by $1,000, not a big deal. But if you miss a scope item by $1,000 and you've got 100 units, that's a big deal. So any mistake is amplified a bit on a multifamily property, so you've got to be really careful to build in those contingencies. Always make sure you expect that it's going to take you longer to renovate than you think it is, and you can't turn as many units a month as you think you can, and always build in an extra buffer in your CapEx budget, and you'll be glad you did, because there's always going to be surprises for sure. And then finally, the third thing, this kind of goes back to the operations. If you're actually interested in getting into this business, you need to know yourself really well. You need to know what you're good at and know what you enjoy doing. Like it says, find your superpower and harness it. It sounds corny, but I like asset management, so I try to make that my sole focus and my specialty. So that's where it comes into where if you get onto a team by finding a deal or investing your capital, that's your time to shine. That's your time to already know before you even get into the deal what you think you might be interested in. Read about it, learn about it, and then show out when you get in the deal, and somebody will notice, and at that point you're off to the races. So.
Awesome. Who has questions for Candace?
In the back.
Okay.
When you were talking about the contingencies, is that a percentage for the class? Are you just topping an actual number? Is it different for D class versus A class? Like, what does that look like when you're building?
So we do 5% contingency, and then we also do a 5% construction management fee, even though we have someone on the team that does that. So it's kind of like a 10% contingency. It's kind of like if something were to happen and we needed to hire someone, we have that money there. It doesn't sound like a lot, but these are typically $600,000 rehab, so it's a decent amount of money. But when I say contingencies, I don't just mean contingencies in the rehab budget. I also mean in the timeline. So the way we look at it, if we have a 100-unit property, the typical turnover is 50% a year. So that's 50 units a year that we could expect to turn. 50 units a year divided by 12 months. That's the number of units we think we can turn a month, right? Like, industry standard. But we don't budget for that. What we budget for is when we take over a property, month 1, 0, month 2, 0, month 3, a little bit less than whatever that figure, 50 divided by 12 is. So we always pull back on that a little bit because we take into account the time it takes to mobilize, the time it takes to lease. So you just got to work in cushions everywhere you can in the underwriting to make sure you're safe there.
Who else has a question for Candace?
What's the range that passive investors usually contribute on, let's say like a 100-unit deal?
So if you're 100% passive, so not a JV partner, but a limited partner in a syndication, most syndications have a minimum of 50,000. Some of them you'll find 100,000 minimums, it just depends, but I think the lowest I've ever seen is 25,000.
Do you do, Schedule C or B? As far as,
506 C or B?
506C or B?
We like, I like 506C better, personally, because most of my investor base is accredited, which means, you know, a net worth of 1 million or more. My team likes 506B better, because most of their investor base are not accredited, not most, but they have a large contact list that's not. So it's a toss. For me, I would pick 506C, but either one. So for those of you that don't know, 506C deals, you can advertise. I can announce, hey, I have a deal, right? I can announce in front of this whole group I have a deal. But you have to be accredited to invest, which means a net worth of 1 million or more, or what is the salary, like 200 or 300,000 a year. 506B deals, you cannot advertise or you will get in trouble. You can only basically pitch that to family and friends you have a pre-existing relationship with. But with 506B deals, you can take non-accredited investors. So sophisticated investors, you know, you don't have to have a net worth of 1 million or more. That's what he was referring to.
Hey Candace, how did you get to the asking price per door?
On the specific deal I talked about, or in general?
Yeah, the first one. Like, you know, you said, what was it, 38,
33.
33 per door? Yeah. So how did you get to that number?
That's where the underwriting comes in. So we look at everything from what the starting point is and what the current cash flow is, and most importantly, what our pro forma is. So where we think we can take the deal, what do we think we can rent the units for, you know, how do we think we can operate it in terms of expenses, what do we think our stabilized net operating income will be once we're done with the whole project. And then of course we also have to project an exit, so we have to assume we're going to exit, say at year 5, and we have to assume the exit cap rate for that market may be 7%. You know, at that time, I think we actually projected higher back 2.5 years ago. But you have to put all that in an underwriting software, and you have to know your criteria for returns. So for us at the time, we were looking for greater than 10% cash on cash, greater than 20% average annual return, and even greater than that for a high-risk deal, and this was a high-risk deal. So that's what we were looking at. I mean, you have to look at the whole picture. It's not really just a simple formula to determine asking price.
Go ahead.
How do you determine the cap rate again?
So for the market cap rate is determined by sales comps of the area. So you can pull sales comps in the multifamily space, and whenever a multifamily property sells, the net operating income at that time is reported. And then based on the sales price, that's where you get the cap rate, right? So it either sold at a 6 cap or it sold at a 5 cap. You compile all those comparable sales and average them together, and that's your market cap rate for an area. So like right now, Southside Birmingham for a B-class asset is somewhere around 5.5, a 5.5 cap rate. We've definitely seen those going
How do you
down.
determine that 5.5 rate?
That's what I'm saying, like it's determined by the properties that have sold. So the NOI of the property and the value of the property at the time it's sold is the cap rate. That's the market cap. Now, there's also a purchase cap rate, which means, you know, the amount you paid for the property and the net operating income at the time you bought it, divided, you know, that's your actual purchase cap rate. But I don't look at purchase cap rates very much. You'll see a lot of people say, well, I'm looking for a 6 cap deal. If anybody's got a 6 cap deal or an 8 cap deal or whatever it is, and send it my way. I don't look at that because I look at value. I want value add deals where I can force appreciation. Sometimes a 3 cap deal is better than a 5 cap deal because you may be able to take the 3 cap deal and make it an 8 cap deal in 3 years because it's under market rent, you know. So I don't look at purchase caps. I look at the market cap rate and I look at the pro forma for the property.
All right, one more question. Tobias, go ahead.
Yeah, you made a mention about refining out of the properties. Are you, and you said that you know, if you are self-employed, you couldn't go to the bank and, you know, get a normal loan. How do you refi out of this 96, 200 unit property? You just go to the bank?
So that's what I was talking about with the benefits of lending in multifamily versus single family. Your multifamily lenders don't really care as much about your income.
Okay.
They care about the income from the property, like the property's ability to service the note. So on the 40 unit that we're refinancing right now, they don't care that my tax returns show a $200,000 loss. You know, they don't care. They care about how much the property is cash flowing. So we're actually going to agency debt for this 40 unit refinance, which is Fannie Freddie multifamily lender. But you can also go to a local bank, and local banks also, depending on the bank, but all of our local bank lenders, they don't care about your W-2 income. They care about the property's ability to service the debt. And they also look at your net worth and liquidity as well.
Right. Clap it up for Candace. Awesome job, Candace. Awesome job. I have one question before you go. Where do you find most of your deals? Are they more off market or on market?
Semi-off market.
Semi-off.
We actually have one right now that's a direct to seller, so that's totally off market. Most of our deals come from brokers
Okay.
that send it to us and maybe like 3 or 4 other teams. So it's pocket listings, as they call them. It's not like they blast it to their whole list and list it on LoopNet or anywhere like that, but we kind of have first dibs, but we're not the only team that has first dibs. That's why I say like semi-off market.
Sweet, sweet. Thank you, Candace. So, how many of you are ready to go and dive into apartments? Raise your